Hello wizards, welcome to the Academy, where we dive into the world of liquidity flows in the global economy. Today, we're going to explore the concept of reserve balances and their crucial role in maintaining the liquidity of the financial sector. Reserve balances, also known as bank reserves, are funds kept on deposit with the Federal Reserve by banks to meet the cash withdrawal demands of their customers. The Federal Reserve uses a combination of tools and interest rates to control the level of bank reserves. Quantitative easing, or QE, and quantitative tightening, or QT, for instance, are policies that influence the liquidity of the banking sector, affecting the level of reserves and respectively increasing or decreasing them. Another thing we could mention is that the Fed pays interest on these deposits, called the Interest on Reserve Balances, or IORB, which ultimately produces a return for these banks and ensures that these funds are kept on deposit within the Fed, instead of being lent between banks, for instance, and circulating in the federal funds market. This happens if the IORB is set above the federal funds rate and the money supply decreases. In contrast, if the IORB is set below the federal funds rate, the money supply increases to stimulate the economy. The auction of new debt instruments such as bonds, notes, and bills by the US Treasury, the TGA, can also impact reserves, as we explained in the last video about the TGA. Furthermore, as we will soon explore in one of the upcoming videos, the creation of new credit and the settlement of old debt can expand or contract the money supply, also possibly affecting reserve balances and liquidity. Since the 2008 Great Financial Crisis, we've entered in the so-called ample reserves regime. In this regime, the level of bank reserves must stay above a threshold deemed appropriate to avoid any issues in the treasury markets. That threshold, as indicated by Christopher J. Waller, a member of the Federal Reserve Board of Governors, should sit at 10% of the US GDP. So, giving a look at the reserve balances chart to help you visualize these concepts, reserve balances are in red. In white, we reported the 10% threshold that could be considered the target of the Fed's monetary policy and QT. A floor of around $2 to $2.5 trillion, below which the ample reserves regime that we just talked about would become a scarce reserves regime, which ultimately means the Fed is unlikely to significantly decrease reserve balances below this threshold. This is very useful to look at things in perspective and to plan your investment in the mid to long term. As you can see, reserve balances are subject to fluctuations based on various economic factors. But since the COVID crash, which you can clearly see here on March 2020, the amount of liquidity injected into the system was enough not just to let the economy recover in record time, but also to produce this incredible run and significant correlation in the years after. It's like the markets became dependent on that liquidity, that when withdrawn with QT, here from December 2022, caused all asset prices to fall tremendously. So there you have it, wizard, an overview of reserve balances and their role in maintaining liquidity in the banking sector. Considering that the US is one, if not the most important economy in the world, understanding the US reserve balance chart is crucial in assessing the health of the markets and making informed investment decisions. Don't forget to like, subscribe, and turn on the bell icon if you don't want to miss the next videos, where we will soon start to look at liquidity from a global perspective.